Okay, so what will be the coverage for today? So first of all, I'm going to do the introduction to inventory valuation. Then I'm going to introduce about the IVS that is being launched in January 2025. Okay, and that particular topic, that is the IVS 230, which deals with the inventory valuation. So we'll go into details of that. Okay, what is mentioned over there. Okay, uh, so allowed CP hours is only 1 hour. Okay, 4 to 5. So I am not going to take this Ind AS 2. That is the accounting standard. Okay, Indian accounting standard 2, which deals with the inventory. Okay, I am going to cover only this much part. That is the IVS 230. What it says about inventory valuation. Okay, so introduction to first inventory valuation. Okay, so what is the need for inventory valuation? Uh, First of all, inventory valuation that is required for financial reporting purposes. Okay. So I would like to ask you where it is reported in balance sheet. Oh, sorry. We can't make it more and more interactive. Sorry. Anyone want to answer where it is reported in balance sheet? Inventory? Yeah, Ashok. Ashok. Okay. So inventory valuation. Okay. So inventory or stock that is being reported at asset side in balance sheets. Okay, and that is the part of current assets. Okay, so your all land and building, plant and machinery, furniture and fixtures, goodwill, intangible assets, that is the part of a fixed asset. And then there is a um current assets also. Okay, so this is the major part of a current asset. Okay, so 70%, 80% of current asset, it constitutes the inventory in case of a manufacturing sector. Okay, then in case of a mergers and demergers, so we have to do the entire business valuation, and there also a major part is of inventory valuations over there. Okay, business acquisitions, then insolvency resolutions, that then liquidations. Okay, so which comes under the IPC. Okay, insolvency and bankruptcy code. Then for tax reporting purposes. Okay, so normally your balance sheet or financial statement, that is a P&L or cash flows. Okay, so uh, that is derived by a CAs. Okay, or a finance department working in every corporate. But this inventory part, that is a stock or inventory valuation, that is always looked with suspicion, with by whom? By tax authorities. And why? Because all adjustment that is being done in inventory. Okay, so they are always with a view, or with filled with suspicion. Okay, and they wants to re-audit it. Okay, and that's why they have made one amendment also in under section 42 A. Okay, and they can now they have got a power to order a inventory valuation once again. Okay, once they have to do the analysis or assessment of the tax. Okay, so they have got a power with the amendment of section 42A. Then transfer pricing. Okay, so transfer pricing happens within the related parties. You must be knowing about the related parties. Okay, so once directors are common, so that is being called related parties. Okay, and whatever sale purchase transactions happens between related parties, there also there is a need of inventory valuations. Okay, then borrowing purposes. Okay, use of inventory as a collateral. There also there is a need of for inventory valuation. Okay. Now, why inventory is important? Okay, why this asset is very important, and why there are so many assignments where you can do a good business. Okay, in case of inventory valuation, because inventory of top Indian companies, if you'll take, okay, if you'll take all this BPCL, then IOCL, HPCL, or Reliance, so you'll find that 77% of current asset. Okay, so that is the amount, or that is the valuation of only inventory. Okay, 77% of current asset. Okay, so IOC there, if you'll take their financials, okay, you'll find 1,21,108 crores. Okay, so that constitutes 77%. Then RIL, we have a less inventory. That is a 48,926 crores. Okay. Then BPCL again 38,065 crores. But again, it is a 68% of their current assets. Then HPCL, rupees 29,575 crores. Again, 67% of current assets. So under current asset, this is the major asset, inventory. Okay. Let us discuss the strategic significance of inventory valuation. Sorry. So, inventory valuation, that is one of the largest assets in the balance sheet of a business entity. And COGS means cost of goods sold. That is being the highest expense in the income statement. So even a minor change in value of inventory can result in big change in profitability of the company. Okay, and that's why this is the often domain, okay, to play with. Okay, inventory valuations for a CS. Okay, why? Because they have to adjust their profitability, and they know that significant thing where they can do the changes. That is the inventory only. So inventory is a significant asset for many businesses, and accurate valuation is essential for financial reporting and decision making. So accurate inventory valuation can help a company determine the true value of its assets, which is important for assessing the company's overall financial health. Okay. So proper inventory valuation is necessary for determining the cost of goods sold, which affects a company's gross profit margin and ultimately its net income also. So inventory valuation is critical for tax purposes, as it affects the calculation of taxable income and can impact a company's tax liability. So accurate inventory valuation is important for managing inventory levels, as it helps a company to identify slow moving or obsolete inventory and make decisions on inventory purchases and sales. Okay, so I'll quote one example also. I worked with Tata Motors Limited in Pune, and they had one subsidiary. Okay, 100% subsidiary. So what happened in year 2000? They faced a major crunch with profitability. Okay, when they launch Indica car. So that time, first launch of Indica car, that went flop. Okay, and that time they decided to work on strategy to make captive or white elephants, okay, as a separate company. And they found that they had one MTD division, that is the machine tool division, and equipment. Okay, so these two three divisions they clubbed down. Okay, and they formed one company, and that name of that company was Tal Manufacturing Solutions Limited. So they used to manufacture whatever equipments required or SPMs required for a Tata Motors line. So this company, what they did, they found out all slow moving or non-moving inventories with Tata Motors, and they just put that inventory. Okay, they just passed on that inventory, entire inventory, non-moving inventory, to Tal. Okay, so what happens? Accurate inventory valuation is important for making informed decisions about pricing, marketing, and sales strategies, as well as for assessing the financial impact of inventory related risks such as theft, damage, or obsolescence. Okay, and that's why normally these corporates they hire uh, good means plant and machinery valuer or engineers, okay, chartered engineers, okay, and they just train them, means they just hire their services to find out the exact stock valuations, okay, because stock valuation is again a technical thing, okay. And why engineers are required, chartered engineers are, because just to know the suitability of that inventory, okay, so they can find out what are the damages happen or obsolescence happen in that inventory, okay. So proper inventory valuation, it helps businesses to avoid misstatements. Okay. Again, playing with this inventory valuation, so that results into misstatements or errors, because financial statement it should provide a true and fair pictures. Okay. In financial statement, which can lead to regulatory penalties or damages to the company's reputations, and that's why this inventory valuation is very important, very important. Okay, let's go into types of inventories. Okay, so normally all these stores, okay, wholesalers and retailers, they have a finished goods inventory, but manufacturers, they have raw material inventory, WIP inventory, and finished good, FGs. Okay, so there are inventory valuation methods also. Those are FIFO methods, first in, first out, then weighted average cost method, then last in, first out method, LIFO method, then specific identification method, then choice of inventory method. It affects the financial statement and relevant financial ratios based on it. Okay. Again, I'll come to the first point that it constitutes a major chunk of current assets inventory valuation. Okay. So that ratios for deriving that ratios also it is important. Exact inventory valuation is important. Okay. So let's find out key inventory management formulas. Okay. So first of all, inventory turnover. So inventory turnover ratio is equal to what? Is equal to COGS, cost of goods sold, divided by average inventory. Okay. So it gives you a turnover, means in a year, how many times you turn your inventory into a finished good. Okay. So inventory turnover, it measures the number of times a company has sold and replaced inventory over a given time period. So it gives an insight into the overall efficiency of a company and its inventory management processes also. The higher the inventory turnover rate, the more efficient a business is at getting through its inventory. Okay, so this is the number one formula, that is the inventory turnover ratio. Okay, so to map performance of the company, this ratio is very important. Okay, inventory turnover ratio, and if you have a less ratio, means from the standard, if you have less ratio, that means normally we look at a inventory turnover ratio as a 5. Okay, but if it is less, that means it resulted into a poor management of inventory. Okay, and there is a non-moving or slow moving inventory with that corporate. So key inventory management formula, again, one formula is there, that is the days of inventory outstanding. So days of inventory outstanding, it measures a typical number of days it takes for inventory to turn into sales. Okay. So number of days inventory outstanding. So it's hard to draw insights from just one calculations. So getting insights into a typical industry standard, it may help in analysis also. Then safety stock. So safety stock is the backup stock. It is needed to meet unexpected supply problems and or sudden changes in demand. So it is always desirable to have enough safety stock to meet unforeseen demand, if any. But level of safety stock should not be so much that increase carrying cost puts a strain on cash flow. So safety stock that is the maximum daily sales volume. Daily sales volume into maximum lead time less, okay, average daily stock volume into average lead time. So that provides you a safety stock. Then reorder point. Reorder point, it helps determine when to order a new inventory. Okay, so it is a specific point. It triggers, okay, in time that acts as a trigger to reorder as soon as the stock has diminished to that certain level. So it is important to consider the lead time for a new stock to be delivered when setting a reorder points. So enough stock should be left over to keep up with the demand before the newly purchased inventory becomes available for the sale. Okay, so you must be knowing about all these things because we all learned it while doing engineering. Then EOQ, economic order quantity. So EOQ is a formula that helps to calculate exactly how much inventory to order. So it takes into consideration an entity's typical demand, ordering cost, and carrying cost to provide the most economical figure possible. So here D stands for demand in units, S stands for ordering cost per unit, and H stands for carrying cost. So under root 2SD divided by H. Okay, H is the carrying cost or holding cost. We call it as a holding cost also. Okay, S is the ordering cost, and D, it stands for annual demand. Okay, so with that, now I will move to the international valuation standards. Okay, which is effective from 31st January 2025. Okay, one moment, please. Let's see. Any questions so far? I'll just check. Uh, I'll just check your questions. Okay. There is nothing in chat box also. Okay. 1 minute. Oh, sorry. Dear sir, your video is not clear. It is blurred. Ashok Devre. Uh, yes. International valuations. Okay. Okay. Ashok, can you talk or not possible? Now it is clear. I'm just asking means just to confirm. Now I'll move to the International Valuation Standard, our core topic. Okay. IVS 230. Okay. So I hope my presentation, uh, this is visible. This is not a blurred or anyone can, or you can write in chat also. No issue. Is that okay now? My presentation is okay or still blurred? Okay, there is one question that I believe a P&M valuer is an apt person for inventory valuation. Please clarify. Okay, so Paneer Selvam sir, I am going to answer this, but in the last. Okay, so I'll take this topic, IVS 230, and after that, I'll answer this. Okay, of course, yes. Okay, answer is of course yes, but I will elaborate more. Okay, after this. Okay, so now I'll move to the core topic. So that is the summary of that is the IVS 230. Okay. So IVS, that stands for International Valuation Standard, and I hope each of us. Okay, so now there are some 62 participants, and I hope that every participants he must be having a copy of IVS. Okay, with him. Okay, and recently. IVS that has been launched, that is being launched, and that is effective from 31st January 2025. You have to use that one. Okay. You should have a latest copy with you. Okay. So this copy that is available on internet also, and you have to just uh, download it. Okay. And you have to go through each and every sections, and whenever you take an assignment, okay, for anything like inventory, or let's say for tangible asset, so every asset or sub asset that is being described over there, means how to do the valuation of that. Okay, so it is just like a bible for us. Okay, so core principle, so a list or core principle for standard setting and valuation has been added to the introduction. So it is newly being added. Okay. Then grocery, the grocery has been extended. Okay. Then IVS 101, that is the scope of work. So valuers preparing valuations for their own employers are now referred to as employed valuers. So valuers preparing valuation for a third party client are called engaged valuers. So that definitions are separated out. Okay. Then 104, that is for basis of value. So section on allocation of value has been added over there. New section, that is a 104. Then IVS 105, that is a valuation approaches and methods. So wording has been reinstated to clarify that market and income and cost approaches are not exclusive and may be used in any combinations. Okay. Uh, So IVS 230 inventory. So this is a new standard and addresses the valuation of goods that will be used in future production, work in progress, that is WIP, and goods awaiting sale. We call it as a FG, finished good. So it excludes real estate and buildings under construction. Why? Because a new section has been added under IVS. It is being called as IVS 400, rear property interest, and there it is being added over there. Okay. So the introduction has been amended to provide additional clarification of what this standard covers, including the valuation of agriculture land and unregistered land also. Okay. So these are all general standards under the IVS. Okay. IVS 101. So it enumerates for a scope of work. Then IVS 102, basis of value. Then IVS 103, valuation approach. Then IVS 104, data and input. IVS 105, valuation methods. And IVS 106, it gives about a documentation and reporting. Okay. And these are all asset standard. Okay. So first one is the guidelines. Okay. Or standards. Okay. Here 101 to 106, and then 200, means from 200 it starts with a asset standards. So IVS 200, that is for business and business interest. IVS 210, intangible assets. IVS 220, non-financial liabilities. Okay, these are all financial assets, huh? Then IVS 230, that is a inventory. Okay, that is inventory. IVS 300, that is a PPE, plant equipment and infrastructure. Okay, then IVS 400, real property interest. IVS 410, development property. And IVS 500, that is for financial instruments. Okay, so these are all asset standard under IVS. Okay, so out of that we have selected IVS 230 for our today's CP topic. Okay. So directly I'll go to that IVS 230, that is the inventory. Okay. So para 20.1 to para 20.3. So inventory, it broadly includes goods which will be used in future production processes. Okay. Means why we keep a inventory? Because it is required for a production. Okay. And through production, we are going to make a finished goods. So inventory, it broadly includes goods which will be used in future production processes. That is a raw material, parts, supplies. Then goods used in production process, we call it as a WIP. And goods awaiting sale, we call it as a finished good. So that is being mentioned in IVS also. Okay. So this standard focuses on valuation of inventory of physical goods that are not real property as the numerous and varied aspects of real property inventory were not considered or contemplated in the preparation of this standard. So the valuation of real property is covered in IVS 400, real property interest. Okay, so it is separated out. Okay, IVS 400 is separated out from a inventory. Okay, so if a builder he makes a lot of flats. Okay, so though that is a inventory for him, but still under IVS it will not be considered as a inventory. Okay, because it is being moved to IVS 400 now. While the book value of inventory only includes historical cost, the profit earned in the production processes, okay, which reflect returns on the assets utilized in manufacturing, including working capital, property, plant and equipment, and intangible assets, are not capitalized into book value. Okay, like in case of plant and machinery, if we purchase a machine, okay, so all freight to bring it at factory locations, then foundation work, then commissioning charges, all these expenses we capitalize. But here in case of inventory, we do not capitalize all these things. Okay. So as a result, the market value of inventory typically differs from and is usually higher than the book value of inventory. Of course, yes. Why? Because market value of inventory typically differs from, or usually it is higher than the book value of inventory. Okay. So normally we do the valuation of inventory at a book value or historical cost. Okay. Then IVS 230 inventory para 20.05 to 20.06. So inventory valuations are performed for a variety of intended uses. So earlier this word was there for variety of purposes. Now it is being removed in a revised version, which is effective from 31st January 2025. Okay, so now this word is used, that is for a variety of intended uses. So it is a valuer's responsibility to understand the intended use of a valuation and whether the inventory should be valued whether separately or grouped with other assets. Okay, so a non-exhaustive list of examples of circumstances that commonly include an inventory valuation component is provided below. So number one, for financial reporting purposes. So valuation of inventory are often required in connection with the accounting for business combinations, asset acquisitions and sales, and impairment analysis. Okay. Then for tax reporting purposes, inventory valuations are frequently needed for transfer pricing analysis, estate and gift tax planning and reporting, and ad valorem taxation analysis, value added. Okay, so that word has come from ad valorem taxation analysis. Then inventory valuation may be for the subject of litigations requiring valuation analysis in certain circumstances. Then valuers are sometimes asked to do inventory as a part of a general consulting, collateral lending, and transactional support engagements, and insolvency also. Okay, so already we have seen all these things why inventory valuation is required, and there we have seen all these things. Okay, then para 30, it starts with basis of value. Okay, because this basis of value is very important. Okay, so on that basis only you are going to do the valuation. Okay, so in accordance with IVS 102 basis of value, the valuer must select the appropriate basis of value when valuing inventory. Okay, then 30.02, it says that often valuations of inventory are performed using basis of value defined by entities or organizations other than the IVSC. IVSC means again in International Valuation Standards Council. Okay. So some examples of which are mentioned in IVS 102 basis of value. So IVS 102 that deals with the guidelines. Okay. So that particular section 102 that that is on basis of value, and the valuer must understand and follow the legislations, regulations, case laws, and other interpretative guidance related to those basis of value effective at the valuation date. Okay. Para 40, it says that valuation approaches and methods. So para 40 says that three valuation approaches. Now you must be knowing what are these three valuation approaches. Okay, being registered IBBI registered users. Okay, and by passing that exam. Okay, and by having that 50 hours training. Okay, so you must be knowing all these three approaches which we follow normally. So three valuation approaches described in IVS 103 valuation approaches can be applied to the valuation of inventory. The method described in these standards simultaneously include elements of cost approach, market approach, and income approach. So if required to classify a method under any one of the three approaches, the valuer should use judgment in making the determination and not necessarily rely on the classification in the following sections 50 to 70. Okay, so 50 section it deals with the market approach. Okay, then 60 that is for a income approach and 70 that is for a cost approach. Okay, so that guidelines that is being given in para 40. Okay, so let's move to the para 40, that is a market approach. The market approach, that is a reference to market activity involving identical or similar good, has only narrow direct application for the valuation of inventory. Such application typically include inventory of commoditized products. Okay, if you have a edible oil company, okay, let's say a solvent extraction plant, soybean oil. Okay, so that commodity. Okay, so here for making edible oil, okay, refined soybean oil, you have to procure soybeans. Okay, soybeans. So that commoditized product, you can do the valuation with the help of a market approach. Why? Because data instances are available. Data instances are available. Okay, then inventory, in which a market exists for the inventory at an interim stage of the in the production process. Okay, if market exists for the inventory at an interim stage, okay, in the production process, so in by taking that as a reference, you can do WIP valuation also. Okay, for non-commodity traded products or products that a market exists at an interim production stage, such as selling prices must be adjusted downwards to account for a disposal efforts and related profits. So while the market approach is not directly applicable in most instances, valuer should consider a market-based indications to determine the selling price as an input for other methods. Okay. Then again, it is being elaborated, okay, in further paras, that is a 50.3 and to 50.5. Okay, market approach is being elaborated. Other observable markets may provide insights on the returns attributable to the manufacturing and dispositions of assets that can also be leveraged for inputs into other methods. Such returns are typically considered to exclude returns attributable to intellectual property. If any IP, that is intellectual property, is being used, so that has to be allocated. Okay, so that in a valuation, so distributor profit margins, it represents a meaningful market proxy for returns on the disposition process if any appropriate base of comparable companies is identified. Okay, then contract manufacturers, to the extent available, may provide a proxy for margins earned through their manufacturing process. Okay, so your valuation, it should be a ad valorem always. One moment please. Hello. Okay. Am I audible? Kindly raise your hand, please. I hope everything is good. Yes, thank you. Thank you. Okay. So where evidences of market prices is available, valuer should make adjustment to those to this to reflect differences between the subject inventory and those involved in the transactions. So these adjustments are necessary to reflect the differentiating characteristics of the subject inventory and those involved in the transaction. So such adjustments may only be determinable at a qualitative rather than a quantitative level. However, the need for significant qualitative adjustment may indicate that another approach would be more appropriate for the valuation. Okay, so typically, let me tell you this. Being worked in a lot of manufacturing companies, and I'm working as a stock auditor for many companies. We do not use a market approach substantially. Okay, for inventory valuations. Okay, but for certain things, like I gave you example for interim products also, if market value is available, then only you can do a market use a market approach. Or for certain raw materials, okay, where data instances are available, you can use this market approach. Okay, and then this is a 50.4. In addition, valuers should only apply the market approach to value inventory. Both of the following criteria are met. Number one criteria, that information is available on arm's length transaction. Okay, there should not be related parties and then data is available between them. Okay, so it should be that information must be at arm's length only. Okay, involving identical or similar inventory on or near the valuation date, then only you can take this. Okay, then sufficient information is available to allow the valuer to adjust for all significant differences between the subject inventory and those involved in the transactions. Okay, so next para 60. Okay, para 60 of IVS 230, that is the inventory valuation that deals with the income approach. Okay, the valuation of inventory using the income approach, it requires the allocation of profit. Okay, value contributed pre-valuation date versus the profit contributed post-valuation date. So there are two methods available under this income approach, and one is the top-down method and one another is the bottom-up method. Okay, so we'll discuss those methods also. So this is para 60, that is the income approach under IVS 230. Okay. The top-down method is a residual method. Top-down method is a residual method that begins with the estimated selling price and deducts the remaining costs and estimated profit. The top-down method, it attempts to bifurcate the efforts and related value that were completed before the measurement date versus those. 1 minute. I'll just. The top-down method attempts to bifurcate the efforts and related value that were completed before the measurement date versus those efforts that are to be completed after the measurement date. Okay. So, in case of inventory valuation, under income approach, top-down method, it is used. Okay, it is also called a residual method. Okay, because it begins with the estimated selling price and deducts a remaining cost and estimated profit from that, and then it arrives at an inventory valuation. Okay, for that particular stage. Okay, and the valuer may use the bottom up approach also. Okay, so that is being given in 60.10. Okay, para 60.10. Okay. So top-down method, first of all, you have to estimate the selling price. Then you have to estimate the cost to complete. Then subtract the cost of disposal, subtract the profit allowance, and consider the necessary holding cost. And then you will arrive at a inventory valuation. Okay. So this is a top-down method. Okay. Then I'll go ahead, okay, because we are running late. Okay, so bottom up method. Next method is a bottom up under this income approach. Here we determine the book value of subject inventory, add any cost of buying and holding already incurred, add any cost towards completion already incurred, and add profit on total cost already incurred. Okay, so that is the bottom up method, and mostly it is being used, okay, while doing the inventory valuation. When determining the cost already incurred, valuer should consider internally developed intangible asset that have contributed towards the completion of efforts. Okay, Then next is the cost approach. Okay, this is a para 70 cost approach. Okay, so mostly used, okay, commonly used approach in inventory valuation, that is a cost approach. The primary method to value inventory is the replacement cost method. Okay, so all raw materials in a company that is being calculated with the help of cost approach. So raw material inventories are typically valued using the current replacement cost method. So valuer must comply with para 60.2 and 60.3 of IVS 105 valuation approaches and methods when determining whether to apply the cost approach to the valuation of inventory. So the current replacement cost method, okay, current replacement cost CRCM may provide a good indication of a market value if inventory is readily replaceable in a wholesale or retail business, raw material inventory. Okay. So cost approach, the market value of raw materials and other inventory may be similar to the net book value as of the valuation date. Okay. But certain adjustments should be considered. So first of all, the book value may need to be adjusted to the FIFO basis. Then if raw materials prices fluctuate and or the inventory turnover is low, the book value may need to be adjusted for changes in the market prices. Then the book value of raw materials may also be decreased to account for obsolete and defective goods. The book value may also need to be decreased for shrinkages, which is the difference between the inventory listed in the accounting records and the actual inventory. Okay, so first of all, you have to do the physical stock verification, actual. Okay, why? Because there will be the variances. Because of what? Because of theft, damages, miscounting, incorrect units of measure, evaporation losses, etc. So the book value may need to be increased for any cost incurred in connection with the raw material preparation. Example, purchasing costs, storage costs, handling costs, all this. Okay. Then para 80, it deals with the special consideration inventory also. Like obsolete inventory, reserves, okay. Then identification of value added processes and return on intangible assets. Okay. Then this para 90, it deals with the identification of value-added processes. The valuation of inventory, it involves an allocation of profit between the profit on pre-measurement date and the profit on post-measurement date. So in practice, profit on may not be proportional to expenses. So in most cases, the risk assume value added or intangible contributed to the inventory pre-measurement date are not the same as those contributed post-measurement dates. So valuers typically should not simply allocate profit in proportion to disposition and manufacturing cost. So these assumptions can misallocate profit as it presupposes that a company production process earns profit on a pro rata basis based on the cost incurred. Okay. So for manufacturers, this method is inappropriate if the cost of material represents an initial outflow without significant efforts. Such an assumption also fails to recognize the contribution of internally generated intangible assets with minimal associated cost. Okay. Then para 90, that is for identification of value processes and returns on intangible assets. Okay. So typically it says that valuers should distinguish between value added cost and those that are not a value added. Okay. The material portions of COGS may not be a value added cost because it does not contribute any profit to the inventory. Okay. For a company that owns internally developed intangible asset that contribute to an increase in the level of profitability, the returns on or of those intangible assets would be included in the total profit margin of the business. However, whether intangible assets are owned or licensed, the market value of the inventory should be the same. Okay. So this 100, it deals with the relationship to other acquired assets also. The valuer should maintain consistency as appropriate between assumptions used in the inventory valuation relative to the valuation of other assets or liabilities. Then there is a separate para on obsolete inventory reserves. Okay, so non-moving or obsolescence Okay, technical obsolescence, then functional obsolescence, all that is being given over here. So the valuer should account for obsolete inventory reserve balances. The inventory reserve balances should be applied to the inventory in which the reserves applies rather than netted against the entire inventory balance. Okay, so typically an obsolete inventory, it is adjusted for an inventory reserve would not be valued as it has been adjusted to a net realizable value. So that is being given over there. Then unit of account, that is also a must, and that is being separately mentioned in your IVS 230 in para 120. Okay, so for purposes of inventory valuation, it is often appropriate to assume inventory is one homogeneous set of assets. However, it is possible for the profit margin, risk, and intangible asset contribution to vary by product or product groups. Okay, so there is a one video available on inventory. Okay, story of inventory. So I would like to play that. That is a 3 minutes video. So we'll see that video. Uh, okay, so we have 5 minutes available, and then 2 minutes will be allocated for a question and answer sessions. So shall I play it? Yes. So here we will end this presentation.